When we talk about technical analysis, we are essentially talking about using the historic price of the asset and analyzing it to predict the possible future price move. In other words, we look at the past data to predict the future. In order to perform technical analysis, we as traders have developed simple and complex indicators that calculate the price in different ways using different formulas. But there is a breed of traders who like to ignore all the indicators and only look at the raw price charts to make trade decisions. These traders are called as price action traders. The objective of price action traders is to profit from chart patterns that occur on regular basis in all time frames. For years, traders have used this approach to successfully navigate through all types of markets. Deciding to become a price action trader can be a very rewarding decision of your trading career. In order to become a price action trader, it becomes very important for us to understand chart patterns and become efficient at identifying them in real time. Firstly, these chart patterns can be generally classified into two categories. Number 1. Reversal patterns. Number 2. Continuation patterns. Reversal patterns are those chart patterns that generally occur at trend reversals. And continuation patterns are those chart patterns that occur as a form of pullbacks in a trend. Under both these categories, we have several chart patterns. In this video, I will be sharing 4 reversal chart patterns that can help you catch major market reversals using raw price action analysis. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. The first reversal pattern that we will discuss is the double top pattern. The double top pattern is a very simple price pattern that is very common among price charts. It is a simple formation that occurs with two price peaks that occur around the same price, with a valley in the middle. Here is a simple drawing of the pattern. Here, we see that the price makes an up move up until the point A. Then, we see a small pullback in the price till the point B. Subsequently, the price reverses and makes an up move until point C. Here, we can see that point C lies in close proximity of point A. In other words, point A and point C are at the same price level. After C, we see a sharp sell-off in price as it breaks below the point B and declines. Our entry will come when the price breaks below the point B. So this is a simple double top pattern. A few points to remember here are: the double top pattern is a bearish pattern. It occurs after a significant uptrend and it is followed by a downtrend. Here is an example. On this chart we have the crude oil futures on a 1-hour chart. Here, we can clearly see that the price was in a steady uptrend in the initial stages. Then we see the market makes a top. We label this point as A. Then the market retraces and finds support at this point. We call it as point B. Subsequently, the price makes another up move but fails to go beyond point A. In fact, it reverses from the point A price level. So, this is a clear sign that the price may be forming a double top pattern. But we will not enter just yet. At this point, we will stretch a horizontal line at point B. This line is called as the neckline. We now have to wait for the price to break below the neckline to initiate a trade. As the price comes near the neckline, we see that the price tries to move up. But that results in failure, and finally on this candle, we see the price breaks and closes below the neckline. This will be our entry candle. We will enter a sell trade at the close of this candle. We will keep our stop loss between our point B and point C. For our targets, we will calculate the distance between point C and point B, and we will extend the same distance below point B to keep our targets. Here is another example. On this chart we have the GBP-USD pair on a 1-hour chart. Here we see that the price made an up move until point A. Then, the price sold off until point B. After point B, the price starts to move up again, but it fails to break above the high of point A. We call this as point C. And then, it starts to move lower. So, we create a neckline at the point B and wait for the price to break it. On this candle we see that the price breaks below the neckline, and we will enter a sell trade here. We can keep our stop loss at the midpoint of B and C. For targets, we will measure the distance between point B and C, which is 44 pips. So we will subtract 44 pips from point B and keep our targets at that price. And as you can see, the price achieved our targets on this trade. So this was the double top formation. Now let's look at the double bottom formation. The double bottom formation is nothing but an inverse image of the double top pattern. Here is a simple drawing of the pattern. We see that the price starts by making a down move till the point A. Then it pulls back up to the point B. The price then starts to come down again, but it fails to break below point A. It creates point C in the vicinity of point A. Subsequently, the price reverses to the upside and starts a new trend. Our entry on this pattern comes when the price breaks above neckline of point B. Here is an example to understand the pattern. On this chart, we can see that the price was initially in a downtrend. It made this massive down move and created the point A. Then, it pulls back up to point B. Subsequently, the price makes another down move. But this time, the price fails to go beyond point A. The price stops near point A and starts to reverse. Therefore, we can call this point as point C. Now we know that the price might be forming a double bottom pattern, but the pattern is still incomplete. We need to wait for the price to complete the pattern before we make an entry. So now, we will plot a horizontal line at point B. This is the neckline of the pattern. On this candle, the price breaks above the neckline, and we enter at the close of this candle. Remember, we want the price to close above the neckline to be considered as a breakout. We keep our stop loss at the midpoint of C and B. Then, we calculate the distance between point B and C and add the distance above point B to keep our targets. And as you can see, the pattern played out really well on this trade. Now, let's look at another example. Here again, we see that the price makes an impulsive down move. It stops and reverses to create point A. Then, it pulls back up to point B and resumes the down move again. The down move is short-lived as the price starts to reverse again in the vicinity of point A. We call this point as point C. We realize that the price might be forming a double bottom pattern. So, we draw a horizontal line at point B and call this as the neckline. Once the price breaks above the neckline, we enter on the close of the candle. We can keep our stop loss at the midpoint of B and C. For targets, we calculate the distance between C and B, which is 60 points. We add 60 points to the neckline, and we place a target there. And as you can see, the price achieves our targets on this trade. So these were double top and double bottom patterns. They are pretty simple and robust patterns that often occur in the markets. The best part about these patterns is that they are pretty simple to understand and identify.